Ladies and gentlemen, good day and welcome to Hindware Home Innovation Limited Q1 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Harsh Pathak from Emkay Global. Thank you, and over to you, sir.
Thanks, Amshad. Hi, good afternoon, everyone. On behalf of Emkay Global, I welcome you all to the Q1 FY26 earnings call of Hindware Home Innovation. From the management side, we have Mr. Nirupam Sahai, CEO of Bath Business, Mr. Rajesh Pajnu, CEO of Pipes Business, Mr. Sandeep Sikka, the Group CFO, and Mr. Naveen Malik, CEO and CFO of Hindware Home Innovation. I'll hand it over to the management for the opening remarks. Over to you, gentlemen.
Good evening, everyone, and welcome to Hindware Home Innovation Limited Q1 FY26 earnings call. Kindly note that some remarks and observations made during today's call might be forward-looking. These may include, but are not limited to, financial projections and statements regarding the company's plans, objectives, expectations, or intentions. The company does not have any obligation to revise these forward-looking statements to reflect any future events or developments. For a comprehensive disclaimer, please refer to slide number 2 of the results presentation. I will start with a brief summary of our performance for the Q1 FY26. Our business CEOs will then share updates on their respective segments. For Q1 FY26, the company reported consolidated revenue of rupees 531 crore with an EBITDA of rupees 58 crore. In a strategic move to sharpen our focus on kitchen appliances segment, including chimneys, hobs, and cooktops, the board has approved the discontinuation of high loss-making product categories such as air coolers, other than through the e-commerce channel, ceiling and other fans, air purifiers, water purifiers, and furniture fittings. Please refer to note number 2 and 3 of published financials for further details. I would now like to hand it over to Mr. Nirupam Sahai to take you through the bathware and consumer appliances business. Over to Nirupam.
Thank you, Naveen. For QY FY26, the bathware business reported 341 crores revenue and 43 crores EBITDA. Despite the challenges in the market, we remain well positioned to leverage our strong fundamentals. Hindware's market leadership, supported by high brand awareness and deep customer trust, continue to be key drivers of our growth ambitions. Our Q1 results reflect the early signs of a business in transformation, with meaningful initiatives undertaken to improve growth, profitability, and margins in the bathware segment. As shared in our previous call, over the past few months, we have undertaken a comprehensive review of our business model, refining our go-to-market strategy, driving premiumization in sanitaryware and faucets, and adopting a zero-based budgeting approach to support margin expansion. These targeted interventions are beginning to yield results, and on the back of this progress, we expect the second half of the financial year to show improved momentum and stronger performance. In Q1, we also deepened our engagement with the influencer community by rolling out on-ground activation programs for the plumber community, while continuing to work closely with architects and interior designers to strengthen our market reach and brand advocacy. Looking ahead, we plan to further invest in brand building to deliver a comprehensive 360-degree engagement with both customers and influencers. In line with our premiumization strategy, we will be introducing a range of premium faucets with higher average selling prices and stronger margins, reinforcing our premium portfolio. We are confident that this initiative will not only strengthen our presence in the premium faucet segment, but also enhance the overall profitability of the business. As we move forward, we remain committed to making disciplined strategic investments in our brands to capture emerging growth opportunities. In our consumer appliances business, Q1 revenues came in at 71 crores with an EBITDA of 10 crores. Over the past months, we have undertaken a rationalization of our portfolio, sharpening our focus on a select set of high-demand categories where we can lead and win. This includes kitchen appliances, which includes chimneys, cooktops, hobs and sinks, and water heaters. As part of this rationalization, we have exited low-margin segments such as ceiling and other fans, air purifiers, water purifiers, furniture fittings, and air coolers in general trade, while continuing to sell air coolers through e-commerce. Alongside this, we are driving cost efficiencies, maintaining disciplined inventory management, and enhancing our after-sales service experience. These initiatives have already started to drive growth in kitchen appliances and are contributing to improved profitability, a positive trend we expect to strengthen in the coming quarters. With that, I hand over to Mr. Rajesh Pajnu to take you through the pipes and fittings business. Over to you, Rajesh.
Thank you, Nirupam. Good afternoon, everyone, and welcome to our investor call. It's a pleasure to be speaking with you today. In Q1 FY26, we reported revenue of 119 crores and an EBITDA of 7 crores. Our performance this quarter reflects the on-ground challenges faced during Q1. The softness was driven by difficult market conditions, volatility in raw material prices, and the early onset of monsoons, which impacted both revenue growth and volumes. In addition, our lower exposure to the agricultural sector, typically a key demand driver in Q1, also contributed to the muted performance. However, we are now seeing early signs of recovery in the current quarter and expect this momentum to translate into a stronger H2 FY26 performance. We remain well positioned to capitalize on the recovery and build on these positive trends throughout the rest of the year. In addition, we have commenced trial production of our new facility in Roorkee, Uttarakhand. Commercial production is scheduled to begin in H2 FY26, which will help us enhance our manufacturing capacity and establish a strong footprint in northern India. We continue to broaden our product portfolio to tap into emerging market opportunities and deliver greater value. This quarter, we introduced a new range of products from foam core pipes for underground drainage, double wall corrugated pipes, polypropylene PPR random plumbing pipes and fittings, strengthening our position across multiple segments. At the same time, we are advancing initiatives across all business functions to optimize resource allocation, leverage technology, and improve productivity and cost efficiency. We have also intensified investment in our brand and distribution network to further extend our market presence and deepen penetration. We are confident that these strategic initiatives, combined with capacity expansion and portfolio diversification, will drive profitable growth as we move forward. We are now ready to open the floor for your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Utkarsh Nopani from BOB Capital. Please go ahead.
Yeah, hi, good evening, sir. So my first question is regarding your bathware segment. So it is good to see that we have posted positive revenue growth for the June quarter. But still our bathware revenue came around 341 crore in this June compared to the quarterly run rate of around 400 crore in FY24. So first wanted to know by when we could reach around say 400 crore quarterly run rate mark number in your viewpoint.
So we expect accelerated growth on the quarterly number from this quarter itself. So Q2 onwards, we'll see higher numbers. We've already seen a move to positive growth in Q1. We expect acceleration based on all the initiatives that we've taken on distribution and on product and on influencers and on brand building. So all of those have started kicking in, and with continued investment, we expect that to accelerate in the coming quarters itself.
Okay. So sir, can you just give some sense like maybe in certain fiscal year, can we reach say 1,600 crore top line in bathware, which we did in FY24, maybe in FY27 or maybe in FY28? We must be having certain target in our mind to reach to that number, what we were doing earlier.
Yeah, so we had run rate by Q3 and Q4 of this year itself.
Okay. And sir, on the bathware margin, if we see it was slightly down on a YOY basis in the June quarter, and as we have taken lot of cost rationalization initiatives in the past few quarters, so when we are going to see the benefit from those initiatives, And what is the sustainable margin for this business in your viewpoint?
So the EBITDA margin for the bathware business is pretty much the same as the last quarter, 12.8% last year, 12.7% this year. At the PBT level, there's an increase from 3.2 to 4.6% in the business. So all the measures that we've taken to drive top line growth, improve margin and control costs, all of them again have started kicking in this quarter, and we expect acceleration again going forward. So on the profitability point of view, whether it's the EBITDA or it's the PBT, we expect this to improve in the coming quarters based on all the actions taken on top line as well as bottom line.
And so what should be the sustainable margin in your viewpoint for bathware?
So we expect it to be in the mid-teens.
Okay. Fine, sir. Now, sir, coming to the pipe segment, so there has been a steep decline in our pipe volume. So it has de-grown by 21% in this June quarter versus low single digit kind of a volume growth reported by the major listed pipe companies, despite we having a very small base. So wanted to know why there has been such a steep decline for us compared to the competition, and what would be the volume growth and margin guidance for FY26 for the pipe segment?
Yeah, this would be a valid question and would be there in the minds of everybody. I would like to put it this way. If you see the same peer comparison of Q4 with all the competitors, we have done much better than others. It was the reason that February and March were peak for us, and we were able to supply a lot of material in the month of March. So what has happened is there was a steep decline in the raw material prices from April. So two reasons. One was the decline in raw material prices, and another onset of monsoons at an early stage. And Q1 signifies more towards the agricultural segment where we are not there. So there was a lot of destocking which happened at the distributor's place. So April and May, mid of May, we could not push the material to the market. And if you see from June onwards, there was a positive correction, and now this quarter, the current quarter, we are doing fantastic. We are there at a volume growth of almost around 35%, at a strike rate of 35%. We have bounced back. And as regards your guidance, we would say that the complete year would be somewhere around close to double digits, maybe around 9 to 10% volume guidance.
Okay. And sir, the next question is regarding your consumer appliance division. So we have taken a pretty large exceptional loss in this quarter. So wanted to know, is it mainly pertaining to the inventory write-off for the discontinued products, and how much inventory we were carrying at the end of June 25?
So these are, I think if you have gone through the notes to the results, so these are write-offs relating to the businesses, and many of these businesses are seasonal in nature. But over a period of time, we had made investments like in certain product categories. We had our own specific modes linked to our designs, like air purifier or water purifier, and even part of the category of water and this air coolers. So it's a mix of when we have done all this provisioning. So we have reviewed line by line items of elements of fixed assets, elements of inventory, and when you discontinue certain business categories, definitely the chances of money getting stuck in the trade is also very high. So considering all these things, this provision has been estimated. We are trying to, get the best value out of it. The board has mandated that we should, try to get the best out of it. If anything is there as we move forward, so it'll be a part of the P&L.
Okay. So for the consumer appliance division, the EBITDA margin has improved sharply. Maybe this might be related to this discontinuation of loss-making product category. So do you expect to maintain such high margin going forward, or is there any one-off in the June quarter number for consumer appliance margin?
If you see the note number 2, there is a one-off item which is relating to, because when we closed all these categories, we have also downscaled our warehousing space. And if you read the notes to the accounts, 6 crore other income is a one-time income, which is relating to the difference between as per Ind AS, the difference between the value of lease assets and the lease liabilities. So other than this, we feel the momentum on the margin, given the fact that we have cut costs in this business also in the past. Now this product categories we have looked at. So the focus now going forward will be on kitchen chimneys and other parts. I'll request if Mr. Nirupam can carry this forward.
Yeah, so the conscious decision to stay in certain categories and focus and win in them. So in the case of kitchen appliances, primarily chimneys, cooktops, hobs, sinks. The reason for doubling down on that is the fact that we see profitability in that business today, and with all the steps we're taking on the portfolio and on cost, we believe that the gross margins and the profitability overall will keep going up in these businesses. The reason that we've stayed with air coolers and e-commerce, again, is because we believe there is profitability in that part of the business. Coolers in general trade was not profitable. So these are very conscious calls for us to focus on certain categories, win in them in the market, while driving profitability as well. So with this mix change and focus on a few categories, we are confident of growing both the top line and bottom line in the coming quarters.
Okay. And so lastly, sir, if you can just guide what would be our CapEx guidance for FY26, and where do we see our net debt at the end of March 26?
So on CapEx, in the bathware business, it'll be roughly between 70 and 80 crores. On the consumer appliances business, it'll be only about 7-8 crores. So that's the CapEx situation.
Okay. And so for pipe business?
Pipes should be somewhere around 15, in a range of 15 to 16, 17 crores based on the approach.
Okay. And where do we see, sir, our net debt at the end of March 26?
Given the fact that we don't have a substantial capex, the capex which got added in last 1 year was primarily on the pipes plant, which is a new pipe plant which we set up in the state of in Roorkee. So given the fact that not much capex is there, little bit from the money which we are generating from the internal accruals, that will go towards that, and that should remain in the range bound whatever it is right now, with the repayment of about 60-70 crores happening in the financial year.
Okay, thanks a lot, sir.
Thank you. Before we take the next question, we would like to remind the participants to press star and 1 to ask a question. The next question is from the line of Parikshit Gupta from Fair Value Capital. Please go ahead.
Thank you very much for the opportunity. I have a couple of questions. First, on the bathware segment, can you please split the top line between sanitary ware and faucetware and share about the industry situations respectively?
Yeah, so our split is roughly about 62% sanitary ware and 38% faucets. We have a strong focus on growing both sanitary ware and faucets, with faucets possibly growing a little faster, and therefore over a period of time, the share of faucets in the overall sales will go up by the end of this financial year. As I mentioned, there are a whole lot of new product introductions that we're planning in both sanitary ware and faucets, largely aimed at the mass premium and premium segments, so higher average selling prices and higher margins.
Okay. Can you give a rough estimate of the margin profile across different brands, Hindware, Italian, and QO?
So we don't normally share the gross margins across the different brands. Obviously we're targeting improvement in gross margin across Hindware, Italian collection, and QO. Like I said, the focus is on launching more products in Hindware, Italian collection, and QO because of the reason of higher average selling price and higher margins.
Understood. Second part of the question on consumer appliances, please. You mentioned earlier in the previous con call that there might be some new complementary product launches expected. I understand that Inflame was also considering dishwashers some time ago. So, I mean, is there any announcement that you would like to make about any new complementary products here?
Not at this point of time. We'll make the announcement at the time that we are planning to launch a new complementary category. At this point of time, as I mentioned earlier, we're doubling down on your chimneys, cooktops, hobs, sinks. We also have inbuilt microwaves and ovens. Those are the categories that we'll remain focused on for this financial year at least, and then we'll add on as we see opportunities. But we believe there's a huge opportunity in these categories themselves.
Understood. Now on the pipes division, please. I think another participant already asked the question about drop in volume and value. Was the drop in value primarily on the account of the agricultural focused quarter and raw materials price softness, or were there any increased competition from the unorganized sector as well? Maybe more capacities being added. We understand about the situation with the larger players, so those numbers are handy. However, any other information if you could please share?
It's not about competition because when it comes to our category of selling in the market, our average selling price is almost equivalent to all the large players, more or less the same. So it was basically, as I said, we had a fantastic March, so there was destocking which was happening at the customer's place, and with it there was this. We are not heavily into the agricultural segment, because for agricultural segment to sell an agricultural pipe, you need to have manufacturing facilities all around the country, as is there with different peers, big peers. So since we are only based out of South, so we couldn't catch that market. As such, as I said, we'll be starting our commercializing our Roorkee plant in H2. So we'll be capitalizing on that. So that was primarily the reason. And as I said, that now things are picked up and we are doing fantastic. We are doing very well this quarter, and we see a comfortable growth in the coming days.
Understood. What was the CPVC share for this quarter, and any plans on doubling down on this particular product segment?
Yeah, the CPVC share, as you all know, that last 1.5 years, the plumbing market has not been that great. Approximately ours was there last 2-3 years at 40%, but last year every major peer, if you see, has shown a degrowth in CPVC. It is now almost around 30 to 35%. And we are expecting in this year, because July has been fantastic for CPVC. We had a share of around 40.5% of CPVC in July, and it's the same way happening now in August also.
This is helpful. Just my last question before I rejoin the queue about the new products that you mentioned, the foam coat pipe, CWC.
Yes.
Would the margin profiles for these products be at the same levels of our current pipes and pipe segment blended margin, or?
Yeah, they are. You can say that all these new products, they are niche products, so they are at a comfortable margin compared to CPVC only, not as PVC, because everybody is not into these products.
Understood, sir. This is super helpful. Thank you very much for answering my questions. I'll get back in the queue. Thank you again.
Thank you. Participants who wish to ask a question may press star and 1 at this time. To ask a question, please press star and 1 now. The next question is from the line of Udit Gajiwala from Yes Securities. Please go ahead.
Yeah. Hi team. Just one question, that a peer is now focusing on the more of the B2B segment, the project segment. So what is our sanitary ware faucets share into the projects, firstly, and what has been the traction for Hindware on those terms?
Yeah. So, we've had a strong focus on institutional business over the last few quarters. We've grown at 15% in the institutional business in quarter one. And I think the focus here is on growing in both sanitary ware and faucets. There's a larger opportunity in sanitary ware, but there's also an opportunity in faucets. So we're showing good growth in both sanitary ware and faucets institutional. We'd also set up a team 3 quarters ago focusing on government, and that is starting to pay off. So basically, we're targeting the government segment as a big potential opportunity. So we're growing every quarter in the government segment, and we continue to build strong relationships with builders and architects across the country. So we see a strong growth momentum in institutional in quarter one, and we see that momentum continuing through the year.
All right, sir. And in the pipe segment, our volume decline has been much deeper than the peers. Is it that we are losing some market share into CPVC, or the pricing is we are not able to have that volume share? And secondly, is there any element of inventory loss for the quarter?
See, this question I have answered twice. The volume declined sharply more than the peers is purely on the basis of, I again repeat, that we had done some good sales in March, more than our peers if you see quarter 4 results. And there was a restocking which is happening, which happened at April and May. From June onwards, we have started doing well, and as I said, we have been doing this quarter Q2. Presently, we are at a growth of around 30% in volumes. So there is no way that we have lost any share to the competitor. It's not possible at this moment. And inventory loss is not more, it is just to the tune of maybe maximum 1 crore for the entire period. Because we are working with less inventories as of today.
Okay. Thank you, sir, and all the best.
Thank you. Before we take the next question, we would like to remind the participants to press star and 1 to ask a question. The next question is from the line of Nikhil Gada from Abacus AMC. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity. So, firstly, sir, on the plastic pipe business, you sort of mentioned that we are expecting a volume growth of 9 to 10%. But I'm assuming that our Roorkee plant will also start from second half. So don't you think that that will also aid volumes?
Yeah, Nikhil, definitely it is going to boost our production capacity here also. What we are talking of presently is at these types of prices, we are also anticipating a price correction. You have a right point. If there is a price correction in by the end of Q2, then definitely this volume guideline will go up. But we are being very conservative at this stage because what has happened is last financial year, quarter 1, we were working at an average price of resin at 85 rupees. Now it is 74 rupees. So we are talking of a volume guideline at these prices. Because once the prices of the raw material are lesser, you produce this type of quantity. If the price goes up, then definitely the volume guideline will change.
So in that case, what kind of revenue guidance can you give, sir?
Revenue is again, if there is, it all depends. If there is at this moment, if we are talking of current prices, then the revenue guideline would be around 3 to 4%. It is there in the industry. But if the prices go back to normal, what they were there last 1.5 years back, then definitely it will be something touching double digits. So we put the caveat there. So much depends on what the prices are there. The raw material prices are there in the market.
Understood. And so just in terms of the competitive intensity in pipes, I think which has increased significantly in the last 1.5 to 2 years.
Yes.
What's your view on that? Are we facing some heat because of that, or we are able to navigate and it's not going to be difficult for us to deliver some double-digit growth even in the future?
Yes. Nikhil, when we started, actually, all these what you are talking about is just there has been a lot of competition because new players have come up in this business. But the level of SKUs which we are working and the new product lines which we have launched this quarter, last 1.5 months, we don't see any, because then we are in the category of the elite people who are there, 3-4 players of our competitors. We don't see any competition from them, because then their segment of business would be entirely different, because they haven't come up with so much of capacity what we are having today and the product lines we have, like BWC and foam core, and now down the line 3-4 months we will be delivering fire sprinklers into the market. So which are all niche products and are anyway there. These people are not there in this market segment.
Understood. And so on the margin front in pipes, so how do we see the margins for FY26? EBITDA margins?
FY26 would be somewhere around 9% and 9.5%.
You think that is doable even after what we have seen in 1Q?
Pardon? I didn't get your question.
I'm saying after 6% margins that we have seen in 1Q, you still feel that we'll be able to achieve?
Yes, because Q1 is the lowest as far as volume, sales value and EBITDA is concerned. If you see pipes business, that is the plumbing side of it, Q1 is the lowest part of this business. Almost 65% of the business happens in H2.
No, I understand that, sir, but then you already mentioned that we are seeing the CPVC share going down for us. And I know that we have done 8-9% EBITDA margin, but at that point of time, our CPVC mix was much higher, right?
In Q1, it was down, but now presently the strike rate is we have bounced back to 40% of the market, share of CPVC, which had gone down to 34%. So,
I understand. Right, sir. And just lastly on the pipes front, do we see any improvement in working capital cycle? Since we are already introducing new products, do you think that it can go up further from these levels, or do you think we can see some improvement?
No, we have maintained working capital. It's already, if you see, Q1 also it's almost around 85 days. So we are on this level last 3-4 quarters. We don't see any going up, working capital going up. It will remain same.
Sorry, sir, I missed the last part. Hello?
Yeah, pardon?
Sir, I missed the last part, sorry.
I said about the working capital, we are maintaining working capital at around between 80 to 85 days last 3 quarters. So we don't see any with these new, since your recoveries are fast, we don't see working capital going up. And if you see pipes business, we have been maintaining it last 4-5 years.
Got it, sir. So just then on the bathware front, you mentioned that we have done good business in the HT and the government side. Can you help us, what is the share of institutional plus government?
So
in overall revenue?
The total institutional sales is 25% of overall revenue in quarter 1.
And how much would be government?
The government right now is roughly about 8 to 9% of the overall institutional sales. We expect that over the next 3 quarters to go up to about 15 to 16%.
So safe to say that 40% revenue will come from institutional plus government. And our assumption is that the margins are a bit lower on this side of the business. So do you think that there could be some impact on margins?
No, government is a subset of overall institutional. So I was talking about the share of government within institutional sales.
Okay.
So the overall margins in institutions have remained fairly steady over the last 5 quarters. So with the mix change, even with government coming in, it's not that the margins have gone down dramatically. So we continue to maintain the same margin level in institutional sales despite growth in government.
And how would be the working capital cycle over here? Which is the retail?
For the bathware business overall?
Yes.
Yeah, so we've shown a reduction of 6 days versus quarter 1 last year. So we've gone down from 101 days to 95 days.
Sir, I get that. What I'm trying to understand is that institutional plus government business. what kind of a working capital cycle is over there vis-a-vis our retail business?
Yeah, there's no significant impact on the overall working capital by increasing the institutional business. There's no significant impact.
Understood. And so similarly in bathware, we have seen new brands coming in the business, and now most of those brands are also 1 to 2 years old. And we have also seen some impact in terms of our market share loss, etc. So, do you feel that to regain that market share and also to grow from this level, is there going to be a lot of challenge that we are going to encounter, or you think that that is something which is more or less we should be in a good position to achieve that?
Yes, I think we are well on the path to regaining some of the market share that we lost last year. All the actions that we're taking in terms of distribution, in terms of new products, in terms of work with influencers on brand building, all of that is going to lead to growth improvement in terms of the growth percentage and in the profit. Like I said, we're targeting for the year mid-teens. So that will be a significant improvement versus. So both on growth and profitability will show significant improvement versus last year, and therefore, again in market share as well.
Understood. But, sir, in terms of demand, because we have seen that the demand has not been great in the market and with new competition coming in, and we have not delivered sort of the growth that we were envisaging for the last 1 to 2 years. So when we say that we are trying to see, or we are rather seeing any improvement, can you give some sort of understanding how and what are the things that are working for us, which is helping us think about the growth that we are looking at?
Yeah. So we have a strategy that we've rolled out over the last quarter, which is basically targeting weighted dealers. So large dealers across the country, the weighted dealers. Our focus is on establishing a very strong engagement with them, rolling out programs for these large dealers and regaining counter share or increasing counter share where it was already high. In quarter one itself, we've seen high double-digit growth in these weighted dealers. So we're targeting about 700 odd dealers across the country, weighted dealers, and we're seeing a high double-digit growth already there. The second is in terms of new product introduction. So roughly about 33% of our sale in quarter one was from NPDs, so launched over the last couple of quarters. And we expect that to accelerate as we launch more and more new products in the coming 3 quarters. So that, again, the strategy is working well in terms of helping us to increase the top line. The third is in terms of basically getting more out of the influencers. So really the engagement with plumbers, plumber meets. We've relaunched the plumber app that we had to make it far more intuitive and user-friendly. All of those actions are leading to far more traction with plumbers as well. Our interaction with architects, because that is going to be a key segment for us going forward, particularly institutional, but also for smaller projects in general trade. So we have specific teams which are working with architects and interior designers. So that again is showing traction already, and we expect that to accelerate. We're also going to be investing in major brand building campaigns in the coming quarters, which includes both ATL and BTL, so above the line, below the line, and a lot of digital. And we believe that's a good way to build the brand, both for bathware and for consumer appliances. So with a combination of all these activities, I think we're confident that the market growth rate is looking like low single digits at this point of time for the year. It may change in the coming quarters, but at this point of time, that's what it looks like. And we expect to grow significantly higher than that, and that's why we're confident of gaining market share this year.
Got it, well understood. So just lastly, on the consumer appliances business, all the product corrections that you've made, how do we see this business, in terms of numbers? What kind of numbers are we targeting for FY26? And also if you can give some understanding on margins as well.
Yes. So in the appliances business, we are targeting roughly about 430 to 450 crores in this year. So that will be, and this obviously is with a base of coolers in general trade, which was there. We've chosen to get out of that category. So the overall growth rate will be impacted by that base. But if I look at the categories that we are focusing on going forward, which is kitchen appliances, air coolers and e-commerce and water heaters, there will be very high growth. So I think that's a conscious decision that we believe that this is the right step to take at this point of time so that we can focus on the key businesses, which will help us to drive high double-digit growth this year and going forward for several years. We're already a very significant player in chimneys. We have high market share in the chimney space. We want to grow the market share in cooktops and hobs and sinks in this year itself. So all the actions are around basically making sure that we continue to leverage the strength that we have in chimneys, but also ensure cross-selling of cooktops, hobs, and other kitchen appliances to leverage on the strength that we built over the last couple of years in chimneys. In terms of margins, again, I think hitting double-digit margins is really the objective that we have for this year, and then building on that going forward.
When you say 430 crores, don't you think the base is very, very high for us to achieve this kind of number?
Sorry, what is that?
So we have seen a 35% degrowth in 1Q, and then when we target 430.
Yeah, so the degrowth is primarily because of the air coolers in general trade. So that was a high base in quarter one. We took a conscious call to get out of that business. So that is the base which has led to the degrowth in quarter one. Now going forward, obviously that impact will not be there. And with high growth in kitchen appliances and coolers in e-commerce, then over the next few quarters, that number will keep increasing.
Got it. Fair enough. And the working capital cycle in consumer, you expect that to remain similar as currently trending, or we are working on improving that as well?
So we are working on improving that as well. So there is an inventory reduction of about 20 odd crores which has happened in this quarter. We'll continue to focus on improvement in working capital. So we expect we've already seen an improvement in working capital in quarter one, and we have targeted action which will ensure that improves in the coming quarters as well.
Got it, sir. One last question to Shikha-ji. Sir, you mentioned, last phone calls that we are targeting close to 250 crores debt reduction in 2 years. Now, when we say that we are looking at 60-70 crore reduction in this particular year, are we to say that we are going to look at close to 180 odd crores of reduction in FY27?
Yeah, no, this depends on the repayment schedule which we have. So the net reduction which I have assumed 60s, we have around 80-90 crores of repayment. And for any new capex which we are planning, we may take another 20 crores. So overall, that's why 60-70 was there. So rest next year we'll have a bigger repayment that is somewhere around 120 crores. So that's how the plan is.
And sir, in terms of the net debt number, where do we see this number to be, 3 years down the line? Are we planning to become debt free in 3-4 years time frame?
So number of initiatives have been worked on, and many of them, I think, if you see the P&L, would be slightly visible right now. I know this will take another few quarters for us to prove. But once we are back in the momentum, the way we were in 2004 and 2024, 2023, I think in 4 years, 5 years, definitely most with all the internal accruals which we are generating, we should be able to pay off the debt.
Got it, sir. Very well understood. Thank you so much for your time.
Thank you.
Thank you.
Thank you. Participants who wish to ask a question may press star and 1 at this time. The next question is from the line of Rahul Kumar from Vaikarya. Please go ahead.
Yeah, hi. So, first question is on bathware actually. We have seen a pretty sharp improvement in the operating margins in this quarter. What has driven that?
Yeah, I think so. There is work obviously that has happened on gross margin, and there's as we had said in the last con call as well, looking at base so that we have optimal costs to drive profitable growth. So I think a combination of the work on gross margin and on cost is basically what is leading to that. We've also focused on increasing the in-house production, the capacity utilization at our plants. So that is also helping. We have consciously over the last few quarters really worked on making sure that we have the optimal manpower as well across the businesses, both in bathware as well as in consumer appliances. So we've taken all the steps that were required to make sure that we have a team that is in place which is fit for purpose for driving the kind of profitable growth that we want in this year and in the coming years. So I think all those measures have paid off basically in quarter one, and I think with continued focus, we believe that will just accelerate in the coming quarters as well.
Okay. And what are the aspirational targets for margins to go by, let's say, by the exit of this year on FY27?
So this year, as I mentioned earlier, we're targeting the mid-teens and then showing improvement on that in the coming financial year, in the next financial year. So if we are at mid-teens, then we go to higher teens by next year.
Okay. Okay. And this number you are saying, is it for the entire year or for exit quarter?
No, so we are actually targeting that for this year, for this financial year, for the full year.
Okay. Okay. Got it. Got it. On the consumer appliances part of the business, I may have missed that, but what is the working capital cycle over there? I don't think it was mentioned in the presentation. And what is the net debt which is there on the part of the business?
Yeah, so the working capital cycle number of days is at this point of time about 130 odd days, 133 days. Like reduce the inventory by about 50 crores this quarter. Reduce the receivables. So that momentum we expect to continue in both quarter 2 and quarter 3. So we'll see a further reduction in this going forward.
Okay. And what is the net borrowings figure for that business?
So on the standalone basis, it's around 35 crores.
Okay. And on the pipes part of the business, can we say that the worst is over in terms of pricing and volume?
Yes, absolutely.
Or are there more headwinds?
No. The worst is almost over. As I said, we are doing very well. We have posted a growth of around 30% volume in July, and we are at the same strike level in August also. So the worst you can say is all over.
Okay. That's all. Thank you.
Thank you. Participants who wish to ask a question may press star and 1 at this time. To ask a question, please press star and 1 now. The next question is from the line of Nikhil Gada from Abacus AMC. Please go ahead.
Yeah, thanks again. Sorry, just one question. What is the timeline for the separate listing of both the companies?
So we have made an application to stock exchanges way back in the month of March. There have been few set of queries which we are responding very fast. So we expect that within next 30 days, 35 days, we should have the SEBI approval in place. Our understanding is that it's taking time with the exchanges right now. And after which we will proceed to NCLT immediately. And there we feel span of around 8 to 12 months or 8 to 9 months or whatever, how the NCLT moves at all.
Yeah, thank you.
Thank you. Participants who wish to ask a question may press star and 1 at this time. The next question is from the line of Raman KV from Sequent Investments. Please go ahead.
I'm sorry, I joined the call little late. I just want to understand that, with respect to the demerger, in the listed entities, it will be bathware and plastic pipes, and the demerged entity will be consumer products, right?
Yes.
And sir, in the presentation, our EBITDA is 58, but when we calculate the EBITDA, I'm getting around 49-50 crores. So I just want to understand the adjustment.
When you add 58, where is 58? So I think you're looking at the consolidated EBITDA versus
Yes,
the...
yes.
So 50, around 50 crore EBITDA is there for Hindware Limited, and balance is towards the Hindware Home Innovation Limited.
Okay, sir. Thank you, sir.
Thank you. Participants who wish to ask a question may press star and one at this time. Ladies and gentlemen, as there are no further questions from the participants, I now hand the conference over to the management for closing comments.
I'd just like to thank everybody who joined on the call today. There have been certain, green offshoots, I'll say, in this quarter in terms of whatever we are trying to do in terms of, improving the overall business, overall operations. I think we'll have to wait, investors will have to wait with us for another quarter or so, as we come back fully in the momentum as we were initially. So thanks again for joining us today. Thank you.
Thank you. On behalf of Emkay Global Financial Services Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your